Hello and welcome. If you haven't heard yet, September has been abuzz with a lot of economic activity. There's been a lot of announcements from the leading economies of the world. It all started on the 18th of September with the US Fed announcing a cut in their federal funds rate by 50 basis points, bringing it down to a range between 4.75 to 5%. Just a few days after that, the ECB in China came to the party. The ECB cutting the deposit facility rate by 25 basis points, bringing it to a low of 3.5%. China wouldn't be left out. It came back and it went and did a series of cuts inclusive of the short-term interest rate as well as mortgage bond rate. So there has been quite an activity, and in this video we're going to look at all those things and what they mean to you. Two questions that we're going to answer in this video. One, why the cuts? And then secondly, how does it impact you as a consumer as well as an investor? This is Friday Money Matters. Thank you for tuning in this Friday and every Friday on this channel. Please give the video a thumbs up, share, as well as subscribe if you have not yet subscribed. Thank you. Let's start with the ECB. The ECB rate came as a result of decreasing inflation in the Eurozone to about 2.2%, which means as far as that Eurozone is concerned, there's a little bit more economic stability. For the ECB, what this really means is they need to do something drastic in order to make sure that there is growth in that particular economic zone. So as a result, the ECB has brought this rate. Now, what are the rates meant to do? Their main objective here is to ensure that there is an increase in spending, because reducing the rates basically means that you are reducing the cost of borrowing. If the cost of borrowing decreases, therefore it means that the price of money has decreased, and this will increase the much needed expenditure into the economy. So as far as stimulating growth is concerned, this becomes one of the main reasons why the cut happened. Now let's go next to the US. Now, according to the US, we see that their move is based on making sure that there is growth as far as the labor market is concerned. Now, of late, we have seen the NFPs dropping. You have seen the figures drastically becoming lower and lower. Therefore, as a main economic objective, the US want to make sure that there is an increase in employment figures. So in order to curb the rising unemployment figures, then there is a decrease in their federal rate. If the federal rate goes down, it comes with that particular added incentives for businesses, for individuals, making the cost of borrowing also a little bit cheaper. And if this is cheaper, it means that businesses can afford to take bigger loans, which they will put into their production capacities, resulting in increased expenditures. However, what it also means is that if the cost of borrowing decreases, therefore the ordinary consumer out there can now afford to take up a little bit more risk as far as their borrowing is concerned. Therefore, any other consumer goods that depend on borrowed money will then appreciate such a move, because if the consumer can afford to borrow, therefore it means that they will channel most of that spending towards particular consumer goods. Therefore, the ones that will face this increase in demand will see robust growth as we move into the next economic cycle. The move by China to decrease the rates, especially the mortgage ones, is because they want to make sure that in those particular sectors, there is an increase in expenditure leading to that increase in growth. But one of the main reasons for the cuts is that the Chinese stock exchange has been performing badly for quite a while. So in order to ensure that there is increase and growth in those particular sectors, especially in businesses, increasing in their uptake of new equipment, new materials and so forth, so that they grow and expand, leading to even a growth that will cascade into other sectors. This had to happen. The rate cut was imminent, and it happened at what we can say is the right time, especially seeing that we're moving towards a high expenditure or a high consumer demand period, especially the festive season. These companies need to gear up for increased demand for their goods. So in order to match the demand, they need to have access to capital that they can now implement into their production capacities in order to cater for the increases in demand that will also grow exponentially. What does it mean for you as a consumer? The cost of borrowing for the consumer has decreased because of a lower interest rate. So as a result, consumers can now take a little bit more risk to use their credit cards and stuff like that. The second thing is mortgage rates. Mortgage rates are going to decrease and are decreasing because of lower interest rates. So because of the cost of borrowing decreasing, we're bound to see an increase for example, in home purchases and so forth, because now people can now access credit or access funding that is affordable for them to take much riskier adventures with their money. As far as savings are concerned, we're bound to see a decrease in that, because remember, savings are dependent on good rate of interest. Now, if the rate of interest is less, people are bound to move their monies elsewhere. Another area that is going to be affected negatively is going to be certificates of deposit, which also are impacted negatively because of lower interest rates. The fourth impact on the consumer is going to be debt management. Debt management is going to be much simpler and much easier, especially with the reduced interest rates, meaning that now you can deal with those other payments that were a little bit below or that were a little bit behind, so that you can catch up. Basically, this is a good time to catch up on those loans that you are servicing. Okay, next let's look at the impact on investors. Now, obviously, with this reduction in interest rates, we're going to see an increase or growth in the stock market, as businesses can afford to borrow at cheaper cost, meaning that they're going to put a lot of money and effort into expansion, into growth, into increase in production and so forth. This is bound to lead to increase in profits as well as increase in incomes overall for businesses that are on the stock exchange. Therefore, if you are looking to invest, for example, in the stock market, look at those businesses that are selling consumer goods, because the reduction in the cost of borrowing means that as consumers demand more because of a cheaper credit, it also means that businesses are going to benefit out of this. So look out for that. On the other hand, the bond market is bound to rise. Generally, when interest rates go down, bond prices increases. However, the people that are going to benefit are those that already have bonds. Those new bonds that are yet to be issued will bring very little return. So if you have bonds, now this is a good time to hold on a little bit to them, and then you cash them a little bit later. Real estate is bound to increase. As I said earlier, if you are looking at buying a stock, try and look for a stock that is in the real estate sector, because the decrease in cost of borrowing will ensure that a lot of people are demanding funding to buy homes. So as a result, such sectors are bound to see a growth and an increase in their valuation. Otherwise, the best thing that you can do right now is to make sure that you pay attention to what other news will come as a result of this news. There's bound to be market corrections here and there. So please make sure that you pay attention to what the market is bringing out as fresh and reliable insights. Please make sure to also consult a registered trading expert or a money management expert. You can go to your bank, you can look them up online. They are all there. Make sure that you can verify the credentials of this person. Otherwise, please stay informed. Remember, the one who has fresh insight is the one who will benefit out of such a market. Please don't forget to give this video a thumbs up, share, and also subscribe if you have not yet subscribed. This is Friday Money Matters. Thank you for watching. We'll see you next Friday. Bye.